Okay, so you learn about deposit and now we're talking about income. So as a general rule of thumb, you can use between about 5 to 7 times as a multiplier to how much income the bank will lend to you as debt. So for example, if you have $100,000 of household pre-tax income, 5 times is 500,000, 7 times is 700,000. So it depends on what's happening with test rates and stuff. And if we relate that to the previous example in the other video about deposit, if you're buying for 800,000, putting in an $80,000 deposit and borrowing 720, then divide that number by 5 to 7, and that's kind of the range that you need to work with as a very simplistic approach, but that's not how the bank does it. The bank does it using a calculator that we have access to as mortgage brokers, and they will factor in your hypothetical mortgage at a higher interest rate to give you a buffer, as well as your income and your usual expenses. And what they want is per month, they want money left over before they approve you. And you might be thinking, okay, that's all good, that sounds doable, but the biggest problem is the income that the bank uses might be different to what you're using, because they need to have verifiable income. Now, if you are self-employed, it's a bit different because it's way more complicated, which I'm going to do at the end of this video. But if you are employed and you have a job, then obviously the last 3 pay slips is a pretty good way of figuring out how much you earn. What adds a complication is if you get bonuses, commission, or overtime, and the way that the bank views that is they'll take the average over the last 2 years and probably scale it down. They won't just take one bonus or one set of overtime. So that's the employed way. If you're self-employed, then it's a bit more complicated. And what we need for proof of income for that is 1 to 2 years of financials prepared by an accountant or by the IRD, where they've kind of sent you that thing back to say, hey, we agree that your accounts is what they are. And the way that the bank looks at your financials isn't as simple as you think. They take into account things like how much you pay yourself, but also how much the business is making in profit. So they'd actually add those two numbers together. So if you pay yourself $120,000 and the business has got $80,000 profit that year, then we add those two numbers together. But if it made an $80,000 loss, we actually have to subtract the $120,000 that you pay yourself with the $80K. So you're only making $40,000. And then on top of that, if you claim things like home office expense, depreciation, or interest, we get to add those numbers back onto the income that we use. And if the business has got debt, which is your debt because you are the business owner, we have to factor that in as well. So that's why it gets a bit more complicated when you're self-employed versus employed. But the main goal is whatever income the bank agrees to use, 5 to 7 times that is around the loan amount that you can get. So on that checklist, that's why it says that on there. You can fill that in, take note of it, and then go watch the next video.